Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we are following in the BNN Bloomberg newsroom. Prime Minister Mark Carney is in Beijing, marking the first visit by a Canadian Prime Minister to China in 8 years. Carney will meet with senior leaders Thursday ahead of a meeting on Friday with President Xi Jinping. Discussions are expected to include trade, energy, and international security. Beijing has proposed easing restrictions on Canadian canola if tariffs are relaxed on Chinese-made electric vehicles. Shares of Wells Fargo are trading lower. They're off about 5.5% right now. The lender missed profit estimates in its latest quarter as severance costs drove up expenses. Revenues also came in below expectations. The bank says it operated with some constraints following an asset cap imposed by the U.S. Federal Reserve that was lifted in June. Wells Fargo plans to continue shrinking headcount and plans to use AI to improve efficiency. Shares of Citigroup also taking a fourth quarter hit. Profit fell in the fourth quarter 13% after the U.S. lender took a $1.2 billion loss, selling its operations in Russia. Market revenue as a whole also saw a decline compared to the year before. On the upside, there was an 84% surge in financial advisory fees, with revenue from handling mergers rising to an all-time record. And taking a look at the markets right now, another down day. After that nice rally to start the year, the TSX is off by 0.35%, but still well above 32,000. South of the border, they're all off, all in the red. You see the S&P 500 down by more than 1%, Dow Jones by more than 0.5%, and the NASDAQ off by nearly 1.6%. Okay, let's turn to the latest in the markets. As our next guest says, stronger, broader earnings and participation will be the story for 2026 and not necessarily rates. We are joined now by Mike Dixon, Head of Research and Quantitative Strategies at Horizon Investments. Mike, thanks very much for joining us.
Hey, Roger, thanks for having me.
Okay, so what makes you think that broader earnings and participation are going to be the story?
Well, as you mentioned, we've seen a little bit of rockiness the last few days with the top of the market. But when you look at what's happened year to date, you do see a very strong response in that kind of smaller mid-cap space with, down here in the States, S&P 600 or Russell 2000 up in the 5 to 6% range, with the large caps kind of converging to zero the last few days. And I think in large part, when you look at what's been happening with earnings over the last few quarters for a lot of these companies, you're seeing a pretty big uptick in earnings growth expectations and a pretty strong momentum forward there. So whereas last year we had a huge concentration of earnings just amongst the top largest companies, you're now starting to see double-digit growth on a forward-looking basis start to appear for some of these smaller mid-caps and other broader cyclicals. And that's a really good sign as we head into the year, very healthy.
And what's fueling that?
Well, I think overall, one of the things that's fueling that, at least on the smaller mid-cap side of things, it was the overall level of interest rates, right? That has been for companies in the smaller mid-cap space that don't have the balance sheets and cash flows that a lot of the mega caps have. That has definitely been a major macro factor that has kept prices kind of suppressed in that area of the market. And we have obviously seen a pretty strong reduction in rates over the last 12 to 18 months. And that's getting to a point where these companies are able to really absorb that. Another thing, I'll point to, overall is just zooming out at the broader economic picture from a consumer strength perspective. And that consumer spending has really been powering GDP quite a bit higher than estimates. And we saw that as well with recent Fed upgrades to those estimates for 2026. And so you've got a very strong consumer in spite of kind of a labor market that's not really growing, but not really shrinking. I think taking those two things combined, those macro forces kind of coming off the table a little bit, but also powered by that strong consumer is where you're starting to see that strong inflection higher. And again, that's the health that we're gonna that we really want to see after the last couple of years where markets have been incredibly concentrated at the top.
And with consumers, any concerns that the resiliency may be running out? They seem to keep going. We talk about the fears of them taking a hit, but it seems that consumer resiliency continues.
It really does appear that way. And, just even today, we got, another retail sales report still for the month of November due to some of that economic shutdown still causing some lag in the reporting of some of this data. But the last couple periods that we've seen for that retail sales, especially for the numbers that are flowing through to GDP, you've got very much above trend retail sales estimates, showing strong consumer strength there. And then if we just look back at the end of December, we got that Q3 GDP number here in the U.S., and you saw a substantial uptick of around 0.8% compared to estimates, having that GDP land in the low 4 range, powered by that consumer spending side of things. So when you're looking at these kind of statistics, it tells you that not only are consumers spending a lot, but there's still a significant amount of money on the sidelines when it comes to money market fund assets. You still have a significant amount of home equity tied up there, with the potential for falling rates to boost that side of the market. So, with positive real earnings and some of those other backstops I've mentioned, not only do you have the spending, you have the fuel to continue to support that spending. And I think that's a great sign for these smaller mid-cap stocks.
Okay, now it has been an interesting start to the year. I mean, we're officially 2 weeks into it, I guess now. And Venezuela, the Powell attack, now the credit card caps. Any concerns about things like that as we get more deeper into 2026?
Well, there has been a lot. There certainly has been no shortage of headlines. A few that you mentioned there, certainly stand out. I think one of the things that does stand out to me as it relates to, outside of the Venezuela situation, some of the other announcements by the administration down here, specifically on the credit card side of things, as well as directing the GSEs to begin purchasing additional MBS to help reduce interest rates on mortgages. One of the things that stands out is this kind of affordability theme, right? Is kind of running through all of this. A lot of the administration's policies that have been proposed, that does run kind of central through all of that. And I think that's really setting up to, affordability being, something that the administration is going to focus on as we head into midterms this year. And the other thing I would say about some of these announcements is it's not entirely clear how a lot of these things are going to be implemented. And so the short-term market impacts, may not be permanent. There's a lot more to do to figure out how a lot of these policies that have been, just tossed out there are actually going to be implemented, and are they going to have the intended effects? That's also not entirely clear. So a lot of information for the market to digest, but I think for now those short-term impacts, are not really going to have a lot of staying power, and the focus on earnings is going to be the main driver as we head over the next few weeks for what 2026 is going to look like.
And you're liking the small and mid caps. Any certain sectors within that, or where are you focusing?
Yeah, I think while we have had the last few years very, tech forward types of focus, of course, starting with the AI theme and the mega caps and kind of working their way down the spectrum, I think what you're going to see this year amongst large caps and the smaller caps as well is a bit more of a value cyclical focus. And what I mean by that, and really what's driving that, is this very strong inflection higher that we have had in economic growth estimates, and then the actual realized data. So, with kind of rates coming down, with GDP growth as high as it is, and expected to continue, and then you also have, from a fiscal standpoint, quite a bit of boost as well with the One Big Beautiful Bill Act, and there's other incentives out there that really support a lot of strong spending. And I think that's going to make a lot of those lower valued areas of the market that have that higher beta cyclical exposure to the economy really be set to take off. And so I think industrials and materials, which can be thought of as kind of like an AI adjacent trade, getting a lot of that CapEx put to good use, and even some of the smaller cap banks here in the U.S., I think all of those are really poised to do quite well as we head into 26.
Okay, we have to wrap it up there, Mike, but thanks as always for joining us.
Thank you.
Mike Dixon, head of research and quantitative strategies at Horizon Investments. Well, the first year of U.S. President Donald Trump's second term has yielded a few lessons for CEOs looking to get more from the White House. Those lessons are coming up. Well, the first year of President Donald Trump's second term has yielded more than a few lessons for chief executives looking to get more from the White House and to avoid any landmines. Here are 5 rules successful corporate leaders are using to navigate the current admin from our colleagues at Bloomberg.
These are such unprecedented times for corporate America. CEOs have really had to evolve and think differently about their approach because Trump is not a traditional Republican. He does not approach the business community in the same way.
He can block a corporate deal. He can do things in terms of regulations that other presidents wouldn't do.
So these are the 5 rules that we've put together based on reporting to help CEOs navigate this administration.
Rule number 1 is find a way in. We know for a fact that Trump is very receptive to direct calls from CEOs and other business leaders that he has a personal relationship with.
The only one that calls me is Tim Cook. He calls me whenever there's a problem.
Historically, you would have many hoops to jump through. You'd have many gatekeepers. That's changed. Trump likes meeting with CEOs and corporate leaders in the Oval Office.
Hearing there from the U.S. president hosting tech executives at the White House.
But not every CEO has Trump on speed dial. So if you're lacking that, you need to go to one of his trusted advisors. That might be Scott Bessent, that might be Susie Wiles, that might be Howard Lutnick, who are all responsible for vast parts of Trump's apparatus. The whole point is you have to find a way in one way or another. Rule number 2 is to quietly maneuver. For CEOs, they want to make sure that their investors and their stakeholders know that they are in the room with Trump. That is a huge boon for them. But what is said in the room then is not something that's going to be for public consumption whatsoever.
Another key part is really just signaling allegiance to the MAGA base, and that can include CEOs bringing gifts to Trump.
This is your Peace Prize. There is also a beautiful medal.
We've seen that with foreign governments. Qatar has tried to give him a new version of Air Force One.
The U.S. government is poised to accept an airplane from Qatar valued at nearly $400 million.
We saw that with Tim Cook, the CEO of Apple, who brought this sort of gold statue to the Oval Office. Rule number 3 in the CEO Trump playbook is really to educate.
Let's take tariffs, for example. A CEO has to very carefully show Trump what actually happens, what are the sort of potential downsides to the American consumer of some of the tariffs he would like to implement. Now, what you cannot do is go forward and say tariffs are a bad policy. So this is a very unique process, but for CEOs who have figured it out, it can be beneficial.
Apple's been very clever about both personal diplomacy with President Trump that gives the company's views kind of a fair airing in the White House.
Rule number 4 is medium matters. If you don't want to call President Trump directly, one thing that you can do is you can speak to him through the news outlets that he watches and reads.
I want to tell you, I listened to a bunch of stuff last night on television. Many of you I know from reading all of our wonderful magazines.
CEOs, knowing this, have decided to maybe recalibrate where they are appearing, where they are speaking, and sort of what interviews they might be giving.
President Trump watched that interview and then changed his perspective.
If you know Trump's appetite for media, you kind of know exactly how to get your message in front of him.
Rule number 5 is everything is a transaction. When you're dealing with President Trump, he wants to be able to announce at the end of that interaction that there's a deal of some kind.
He walked in wanting to keep his job, and he ended up giving us $10 billion for the United States.
What this means for CEOs is that they need to bring something to the table that they can essentially trade.
That often can just be promises. It can be sort of a pledge to build a factory in a swing state, or a pledge to hire more workers somewhere, or a pledge to invest in the U.S.
President Trump will announce that Apple is going to commit to spend another $100 billion on domestic manufacturing. That's the latest pledge by the tech giant.
So I think a takeaway for CEOs looking to sort of build rapport with the White House is just that Trump wants to make a deal. He wants to be given information that he can use to tout the economy. And that is really the playbook for CEOs for Trump's second term.
Up next, we'll be joined by U of T professor Dr. Arvind Gupta to break down how this year could mark a shift in Canada's EV market. Prime Minister Mark Carney's China visit has brought the spotlight back to electric vehicles, EVs. There are questions about whether there will be any changes to the 100% tariffs on Chinese-made EVs. Here to talk more about the Canadian EV industry is Dr. Arvind Gupta, professor of computer science at the University of Toronto. And Doctor, thank you very much for joining us today.
Yeah, thank you for having me.
What would what would be good to come out of this meeting when it comes to EVs? I mean, there's that tariff on, but realistically, I don't think we'll see that disappear. What would be a good success from the Canadian side for EVs?
Well, I think what this is showing is that the EVs are the future mobility solution. And we're going to have EVs here. They're going to become adopted, whether it's Chinese EVs or other EVs. So the question for us is, how can Canada be part of this EV revolution?
Any concerns? I mean, we've seen a drop off in sales, the concerns about cold, EVs in the cold. Do you think this is just a blip as opposed to a longer term?
Yeah, I mean, definitely we're getting over some of these issues. If you look at Norway, where 90% of all new car sales are now EVs, Iceland, over 50% of new car sales are EVs. People are figuring these things out. It's just a matter of time before we see much wider adoption in Canada.
And why do you think there is the hesitancy with EVs in Canada?
Well, you know, we had the EV rebates, helped make them much more affordable. I think people were front-end loading their purchases while the rebates weren't there. We did see in the fourth quarter an increase again in EV sales. But for me, I look at electrification. When you see that countries like India, 75% increase in EV sales last year, when you see that worldwide, something like 35% of all cars are now electrified, this is all coming at us.
And we need to be in there somewhere.
We need to be part of that supply chain.
Now, should we be trying to build an EV or should we be trying to fit in?
Yeah, so different people have different views on this. From my perspective, we start developing core technology all the way along the supply chain. So it could be in critical mineral mining all the way to building the EVs, building the charging infrastructure, remediating batteries. I think that's in the place that not enough attention is being paid to.
Yeah, we have to get rid of them somewhere, right?
Yeah,
do something with them.
Well, you know, they're a great source of critical minerals. So remediating the batteries could be a big business. So we should be part of that whole system.
And how are we doing when it comes to being a part of it?
Yeah.
I mean, we've been so used to building gas engines that are gas-powered vehicles. Are we ready to kind of get into this?
Well, we definitely have companies who are very good at auto manufacturing, auto parts manufacturing. We have also lots of great technology. We have some great semiconductor companies. You know, EVs are essentially computers on wheels. So we're going to see a big need for advanced semiconductors, advanced control systems, software, as well as the robotics, the manufacturing side. So it's a big ecosystem. Mm-hmm. And the question really is, how do we become a critical player in that?
And you said there are Canadian companies that offer all the, are they taking advantage of it? Are they getting involved in it now?
Yeah, that's what we're finding. We're just launching a new initiative out of the University of Toronto, bringing a bunch of universities together to start developing these technologies, seeing lots of interest from companies who are looking to get a step ahead of their competitors. So I see lots of potential here.
And what is the next big breakthrough when it comes to EVs?
Yeah, if only I knew.
Well, what are you working on then? How about that? Or what are they working on?
Definitely, I think the semiconductor side is a big place. Maybe broader microelectronics is a place where we can be big players. I think battery technology, and you point out that in the cold, batteries don't last. So what is the next?
We saw with Samsung, right? Samsung has talked about they had one that'll a 9-minute charge.
The solid state batteries are coming, and solid state batteries will have much faster charging, much better performance in the cold. So that's a place to think about. I think critical mineral mining. We know China is really the world leader in processing critical minerals, but creates a lot of pollution over there. So the world will be looking for places that can mine critical minerals in a more sustainable way. Big potential for us. We have a lot of critical minerals. So there's lots of places we can play, lots of companies in Canada that could be players in this area. We just got to make sure we give them the tools to get a step ahead of their competitors. And
that sounds like the political will, because I mean, with the critical minerals, we've talked about the Ring of Fire in Ontario, but we've talked about that. I think I remember doing stories on this 20 and 25 years ago. How do we convince people we have to move forward on this? What will it take? And expenses too. It's not cheap.
Well, going back to Mark Carney, I think this federal government has made it clear that they're on the move. They're going to get this stuff done. And so I'm looking for them to send those clear signals that we want to be a player in these various places. So whether it's critical minerals, whether it's battery technology, whether it's remediation, whether it's semiconductors, we need to be a player.
And we had a battery factory coming in here, but it seems like it's fallen apart, or we haven't heard much about it. Do we have the capacity and the will to do it, do you think?
We definitely have the know-how.
Yeah.
The tariff situation has created upheaval, and so we're going to have to get through that. But let's take some of our homegrown companies and get them up to speed. I mean, you're talking about battery manufacturing. I'm talking about, can we devise a next generation of batteries? So those next generation batteries are built here.
Any concerns that you're seeing the brain drain, people leaving here because they see the opportunities elsewhere?
Well, this is another reason that we should be developing these advanced technologies here. It'll keep our young people here. All the projects we've done have seen, really amazing talent, young people working on these ideas, wanting to stay here, wanting to commercialize here. So by focusing on advanced technology development, we will keep the talent in Canada.
But are we losing them now, though?
Definitely in some areas. I'm a computer science professor. We know that many of our young people are attracted to Silicon Valley. Once we start working on these kinds of projects, though, we see that many more of them stay. I think the latest statistic I saw is almost double the retention rate when we do the technology development here.
But the time is now.
We have to get moving on it. The time is always today.
Okay, we'll leave it there. Doctor, thank you very much for joining us today.
Yeah, thank you.
I know you're ready to go home. You told me you just got in from India this morning at 6 o'clock. So go home and have a nap. But thank you very much for joining us.
Thank you.
That was Dr. Arvind Gupta, Professor of Computer Science at the University of Toronto. Well, U.S. big bank stocks are under pressure. We'll tell you why after this. Corus Entertainment saw revenue drop 18% in its most recent quarter as a prolonged advertising slump continued to weigh on the company. Corus posted a net loss of more than $11 million, with TV revenue taking the biggest hit. On the upside, the media company says the completion of its proposed recapitalization transaction will deliver substantial balance sheet improvements. Luxury retailer Saks Global has filed for bankruptcy. The American company is preparing to reposition itself after obtaining about $1.8 billion U.S. in financing commitments. Saks' top executive stepped down earlier this month as the firm struggled with debt from its acquisition of Neiman Marcus in 2024. The retailer is also facing increasing competition. Oil major BP expects to take a hit of $4 to $5 billion U.S. in the fourth quarter, mainly due to impairments in its low-carbon energy business. The British company slashed its annual spending on energy transition businesses about a year ago. BP is redirecting spending to oil and gas to boost returns under the new leadership. The energy company also warned weaker oil trading and falling prices will weigh on fourth quarter earnings. And taking a look at the markets right now. Yeah, TSX having another down day right now. It's up by 0.1, but still, it is up for the year. And south of the border, it's a similar situation. Everybody in the red down there. S&P 500 off by nearly a point. The Dow off by 0.43. And the NASDAQ off by 1.5% right now. Rough day all around. More U.S. big bank earnings rolled in today, but shares of Citi, Wells Fargo, and Bank of America are all under pressure. Let's find out why. Joining us now is Erica Najarian, Managing Director of Large Cap Banks and Consumer Finance at UBS. And Erica, thanks very much for joining us.
Thanks for having me.
Let's start with Bank of America. The numbers they look okay, but not everybody's happy.
You know, I think in general, what's happening today is that the fundamental expectations were largely positive from investors, for the year in terms of lending growth, investment banking, cap markets, trading. And I think this is really a situation for all three banks of expectations getting a little bit over their skis relative to what they can deliver. Now, I think actually Citi just got swept up in the de-risking. They actually had pretty solid results and a solid outlook. But you asked me specifically about Bank of America. I think where the market is really sort of disappointed is that the expense leverage that they promised during their November Investor Day, which is, by the way, their first in 15 years, so the expectations were high, was not quite where they wanted it to be out of the gate. So this feels very much expense leverage driven.
Okay, and moving on to Citigroup, we heard the CEO tempering expectations on the regulatory penalties during the earnings call. Is that what is affecting things today, or is it just overall?
Honestly, I think everything that I heard from the Citigroup call was pretty positive. They're getting some of the regulatory issues behind them. And as they do that, they're going to free up expenses that had been, essentially designated to resolve those issues. The revenue outlook was a little bit better than expected in terms of interest income. Markets and investment banking should still be resilient in 2026. I think what you're really seeing here is that, again, it's kind of the proverbial throwing the baby out of the bathwater. The investor base is generally de-risking their long positions in money center banks. And so Citi is just getting, is a little bit of a victim, even though their actual results and outlook was probably best in class today.
It sounds a little bit like the Mag 7 when we were waiting for their earnings last quarter. It didn't matter what they do. People are going to find something to be unhappy about.
Well, I think, and look, bank valuations are not usually at this level. Bank investors are not, quote, used to nice things. And so when you're at this level, they expect you to leap over expectations. And that's not quite wasn't what was happening this morning.
All right. And the other one, just quickly, and then we'll maybe talk a little bigger picture. Wells Fargo as well. Your thoughts there?
Yeah, look, they were unshackled from the asset cap. Which comes with it both expense freeing and also they can now grow their balance sheet. So while that's all a very positive story, I think honestly, the investor base got a little ahead of itself in terms of what that would interpret in terms of revenue growth and expense growth for 2026. So while everything, again, is going in the right direction for Wells Fargo and the momentum is pretty strong there, I think, again, it's just a matter of expectations getting ahead of itself.
And for all three, where do you stand? You've got buy rating on Wells, and what about the other two?
Yeah, I have a buy rating on Wells. I have a buy rating on Bank of America. I have a neutral rating on Citi. To be quite frank, I just sort of missed it last year. And generally speaking, we're positive on the banking sector, for the year. But our main message is, look, at these valuation levels, you've got to pick your spots. It's not just going to be as easy to outperform the broad market for three, straight years. And you're seeing that, and I think that our main message is that while all the fundamental drivers are quite positive, the valuation is telling you, be careful about where you deploy new money into U.S. financials as you head into 26.
And now we heard from the president talking about a cap on credit card interest. Is that realistic? Is that weighing at all on the markets right now, on the banks?
So it was definitely a huge factor yesterday, but I guess I'll answer it in two parts. The first is a permanent credit card rate cap is going to absolutely just curtail credit availability, and not just for the lower income American, but for the middle income American. The economics of credit card in terms of loss rates, funding costs, and the cost to run that business just doesn't work with a 10% rate cap. I think that what could be interesting is, and we actually saw, a small credit card company called Built make the headlines just a few hours ago. But what could be interesting is that, the president of the United States likes concessions. And so I wonder if a standard introductory interest rate, which all the banks offer a standard practice of 10%, is something that could, mollify the president as he, marches towards this affordability campaign ahead of the midterm elections. You saw this small credit company called Built essentially say, well, new purchases on Built credit cards are going to be capped at 10% for a year. Again, that's no different from an introductory offer. But when marketed that way, it does sound like a concession. So I wonder if that's sort of the pound of flesh that might have to come, from all this tweeting.
All right, we'll leave it there, Erica. Thank you, as always, for joining us.
Thank you for having me.
Erica Najarian is Managing Director of Large Cap Banks and Consumer Finance at UBS. Up next, a global delivery platform, which started in Toronto, is marking a decade this month. We talk more about their business strategies right after the break. You might have ordered dinner from Uber Eats last night, but did you know the delivery platform was born in Toronto 10 years ago? And here to talk about it now, about the market for the delivery services and where it is 10 years on, is Lola Kassim, head of Uber Eats for Canada. Lola, thank you very much for joining us today.
Thanks for having me.
A 10-year anniversary. What made you choose Toronto for the starting point for it?
Great question. So if you think back about 10 years, Uber was a really exciting and innovative place to work, especially in Toronto. So it was a time when the Uber rideshare app was growing and scaling. And Toronto was one of those markets where the company was doing a lot of experimentation and innovation. And really, if you think about the factors that we've got here in Toronto, we have a really dense cosmopolitan city. We've got a diverse restaurant scene. And we had a fantastic base of talent here in Toronto that was open to trying and testing new things and doing really well. And we also had a bunch of delivery people who were open to trying delivering food. So we had really kind of a panoply of factors that contributed to making this one of the best cities that we could possibly launch this product in.
And now, 10 years on, what's the biggest change that you've seen? And you've been with them for a big chunk of it. What's the biggest change? What's the biggest challenge?
Yeah, so I've been leading the business for the last 6 years, and we've seen a lot of change. But what I would say is the biggest change we've seen is that this has become less of a luxury, I'm going to treat myself by ordering Uber Eats, to something that people really see as providing day-to-day convenience and value. So it's just become ingrained in people's habits. And I'd say another key piece is that people are looking to Uber Eats, not just for their restaurant meals, great, people are still ordering their breakfast, lunch, and dinner. But we've been able to expand to meet consumers' needs to have just about anything delivered on demand. So whether that's groceries or pet food or alcohol, even cannabis, which we now deliver safely and reliably, we're just able to meet consumers' needs to get just about everything, just about anything at that need, at that speed and the reliability that people are looking for.
And you've had competition come in. What's the biggest challenges you've faced with competition, and what do you learn from them?
Yeah, so competition is great. It really keeps everyone on their toes and makes sure that we are continuing to push and innovate to provide the best service available to Canadians. So I'm proud to say that we are by far the leading delivery player in Canada, but we've gotten to that place by really focusing on our customers' needs. What do our consumers want to see? What do our restaurants or the other retailers that we partner with, what are they looking for? How can we help them grow their businesses? And then, of course, the people who are delivering on their app, we want to make sure that they're able to have flexible ways to earn money. And I think another key piece for us in making sure that we're distinctive and differentiating ourselves is making sure that we're available for as many Canadians as we can be coast to coast. So we now operate in more than 400 cities. We cover 85% of the population. We're not just in, the Torontos, the Ottawas, Vancouvers, but we're everywhere, including, Yellowknife and Whitehorse. So we're really passionate about making sure that we can provide that speed, that convenience, that value, that access to people across the country.
Now, one of the challenges for Canadians right now, I think a lot of Canadians, is finances and struggling with cost. Are you noticing a drop, and how are you approaching that to try and keep customers? Are you losing customers because they're having to make the decision of, it's too much to get it delivered, it costs too much to get it delivered, I have to go get it, or I won't get it at all?
Yeah, no, great point. Times are tough for Canadians, and I think that means a few things. One, people are looking for value, which is something that we've been really leaning into, especially with our restaurant partners and our other merchants. How can we offer deals and offers to help Canadians at this time? But of course, when people are busy, people are still looking for that convenience and that value. So as long as we're able to deliver that, we've continued to see the business grow and grow. We've also been leaning into other ways to create value for consumers. For instance, we have our membership product called Uber One. So if you're an Uber One member, you are able to get $0 delivery fees. You're able to get cash back on some of your rides and also your deliveries as well. So yes, affordability is key, and we're continuing to look for ways to make sure that we're providing a service that's convenient, but also providing the value that Canadians are looking for right now.
McDonald's lowered some of their value meal prices and freezing prices. Have you thought about lowering some of your prices or freezing rates?
That's a great question. So when you think about it, we are a platform, and restaurants or other retailers, they list their services on their platform, and they're able to set those prices. But are we working very closely with those retailers to see, hey, how can they reduce prices, provide offers like buy one, get one deals, all of those kind of things? That's something that our teams are working closely with them on.
What about your fees as well? Have you thought about that? Just the fees that you set?
And in terms of the fees that we set, we're always reviewing them to make sure that, the system makes sense, right? Of course, we've got several sides to the marketplace. We have our delivery people who we need to make sure are earning, fair and sustainable earnings. We have restaurants who are doing this to grow their revenue base, but also their businesses. They need to make sure that they're able to stay afloat. And as you mentioned, we've got our eaters who want to make sure that they're able to use this service, but that it's valuable and convenient. So we're always looking at the interplay between how things work for those three sides of the marketplace as we review our fees.
I just want to get one more question in. But technology, driverless cars are approaching. How do you see them fitting in with a food delivery service? Would people be willing? Do you think they'd be ready to go out to the street to get food and have it rather than have it delivered to their door? How are you approaching that, and AI as well?
A great question. So when it comes to autonomous delivery and driving, obviously that's the way of the future. And this is an area where Uber is really leading with pilots around the world. I think we shouldn't be surprised if we start to see more and more autonomous vehicles in cities globally, and I think eventually Canada at scale delivering food. So I think that's something we're definitely going to see in the future. And when it comes to AI, we are a tech-driven company. So AI is nothing new for us. And so I think this is something that's been in the background, helping us optimize our services and build the best marketplace possible. And we're going to continue leaning into AI to provide a better consumer experience, whether it's how you order in the app, whether it's how you order with other AI services you use, and also the customer support that we're able to provide.
But do you think people would be ready to come out, like if they're in an apartment and they're going to have to come down and get their food outside in the rain? Do you think they'd be ready to do that?
Well, I have seen, looking at other pilots that have happened, in other places, there's a bit of a novelty factor to it. So I think people are excited to see new technology. If you think back to the first time you took an Uber ride or you ordered on Uber Eats, people are excited about that. And it may require a little bit of shift in behavior or shift in mindset, but I think it's something that people will be excited to see, and we'll have to, again, respond to how consumers are taking that product so that we can, optimize going forward.
All right, Lola, thank you very much for coming in.
Thank you.
And happy anniversary.
Great.
Cheers. Lola Kasim is the head of Uber Eats for Canada. Coming up, luxury retailer Saks Global has filed for bankruptcy, and there's a Canadian connection. BNN Bloomberg's Lindsay Biscaya will break it all down right after the break.
Tonight, the spouse of Canada's worst mass killer breaks her silence.
And I'm thinking his paranoia, like he's getting crazy at this point.
Shocking details of his spiral before the rampage and how she was also terrorized. Tonight on CTV National News and watch on Crave.
Know Your Options is back. Tune in today at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions at knowyouroptions@bnnbloomberg.ca. A luxury retailer, Saks Global, has announced it's filing for bankruptcy. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. Another one, bites of dust.
Yeah, this is the owner of Saks Fifth Avenue. So we're talking department stores here. This is a luxury department store filing for Chapter 11 bankruptcy, which gives the company, like Chapter 11 gives the company time to kind of reorganize and try to get things off the ground again. So Saks saying it has secured financing, but it's been going through some troubles recently. This comes after the company took on massive debt to buy Neiman Marcus back in 2024. That was its rival. So it bought Neiman Marcus for $2.65 billion US, and since then it has been dealing with all of that debt. And then not to mention competition, which we're seeing with a lot of department stores all over, right? Competition when it comes to people shopping online instead. They're just not getting the traffic, I guess, through the doors that you used to get. Now, this is all coming amidst a bunch of CEO changes too. Richard Baker had taken over as CEO and executive chairman after the former CEO stepped down earlier this month. Now Richard Baker is walking away from the position of CEO, and they have secured a new CEO, Jeffrey Van Rumdonk. But it's interesting to focus on Richard Baker, because he does have a bit of a Canadian connection when it comes to the Hudson's
It's quite
Bay
a trail.
Company. It's quite a trail. It's very interesting to see. He's been around for quite some time. He has had some successes, some not so much successes. So he bought Lord & Taylor, another department store, in 2006, and then he acquired Hudson's Bay in 2008. He helped to turn both of those stores around for quite some time. Both were struggling when he bought them. He did help to turn them around, but then Hudson's Bay, of course, in 2019 started to see declines again. He tried to launch Hudson's Bay into the Netherlands. It didn't go so well, and we know since then where the story ended when it comes to Hudson's Bay. And then he sold Lord & Taylor with that chain folding soon after that. But what's interesting is he is behind Saks buying Neiman Marcus in 2024, which of course is kind of in a way led to a bit of the demise of Saks that we're talking about today. But he was behind that because Hudson's Bay was the owner of Saks at the time. So there's a whole big web here, and he's an interesting character to follow because he does have that history of both winning and losing when it comes to this interesting market that's going through crazy changes.
What is, and the high end, because I mean, we've talked about the K recovered, the K economy, and a lot of the high end were doing well, but then to see one of the high end department stores. So what does that say about other department stores?
Well, and that's the thing, particularly when you're talking about luxury department stores, like we have seen when it comes to consumer spending, at least in 2025, those who had a higher income were still spending. But it seems as though when it comes to luxury department, studies are showing that global sales of luxury goods are expected to contract in 2026 for a second straight year. So people just aren't buying as much when it comes to those luxury items. We were speaking with Jack Manley of Morgan Asset Management earlier today. He was talking a little bit more about the kind of demise we're seeing of brick and mortar ever since COVID. And he says, brick and mortar stores and retail, it's not dead, but they do need to change along with the times. And he gave some examples of how they should be doing that. Take a listen.
Adding something to the mix. What's working in retail? I mean, it's where your nail salon is or your fitness studio is. It's where the movie theater is, the arcade, the brewery. That pocket of retail has actually done quite nicely. The other pocket of retail that's done quite well for quite some time has been the luxury side of things. Because, if you're going to be spending a lot of money on something, whatever it happens to be, a handbag, a watch, a suit, a car, generally speaking, you want to touch the thing, right? You want to see it in person. You want to be there and experience that good before you lay your cold, hard money down on the table and purchase the thing.
Right. Like when you are purchasing something that costs more, you want to see it before you actually buy it. Yep. And he says when you think of luxury retail, you're thinking of like intimate boutiques, not so much big story, like 4 or 5 story department stores. So
we got to go now.
Yeah.
Lindsay, thank you. BNN Bloomberg's Lindsay Biscaya. And that wraps up this edition of Trading Day. Have a great afternoon.